Larry Shover, he's the managing director of Exchange Capital Resources, joins us this morning to, well, take a look at some of the activity we've been seeing in commodities this week and get ahead of that EIA data that's headed our way. Larry, good morning, welcome, and thanks for sharing part of your Friday with us. No numbers for us to look at the bottom of the hour, but at the top of the show, we were talking about some of the PMI data that's come in a little bit disappointing, to say the least here, whether you're talking Japan, the Eurozone, or Germany. But the question was, Larry, I guess, should we be looking more closely at today's data, having come off of some disappointing data internationally?
Yeah, I mean, perhaps looking for that common thread. And yeah, Japan, Australia, Europe, the PMIs really didn't do a whole lot to help the reflationary narrative that commodities, rates, and hence FX were counting on even a week ago. And so perhaps we got a little bit ahead of ourselves, who knows? But yeah, today's data, albeit light, is definitely worthwhile looking to see if there is some type of common thread. As we know, next week's going to be heavy with some top-tier data, especially consumer confidence. But today is today, and looking for that common thread is, crucial right now.
Yeah, common thread. In this case, it would be a negative one, Larry, and ultimately that, in theory, would kind of weigh on commodities, at least the crude oil and potentially copper. I mean, there's been a lot of optimism. I've been saying we, in some ways, have put the cart before the horse on this one as far as expectations and these vaccines and just sort of discounting many of the unknowns. But let's talk about China limiting some of the travel. That's a major concern if you're talking about, well, if you're bullish crude oil in many ways. China has, raised some eyebrows in terms of, well, not just China. I mean, globally, we're seeing lockdowns. UK, I think it was Boris Johnson just mentioned this morning that some of these lockdowns may be extended into the summer. I mean, ultimately, this is going to weigh on demand in theory, and you can see crude prices coming off, whether they're just in tandem with the indices this morning or amidst some of those concerns. Ultimately, this is something for traders to be dialed in on.
Yeah, no, I think it's a combination of both. I mean, the markets seem to get ahead of themselves all the time, and we as traders do as well. And then we get these reality checks. And, for me, it all started last week when, 10-year treasuries just could not push through 119. And, a week ago, we were 111, 115. You look at break evens, less than 200 basis points. And so all that to say, I think the house of cards kind of collapsed, temporarily, and just affected everything, whether it be copper, whether it be oil, gold, a great example, and the stock market. So all that to say, we got a little ahead of ourselves. The economic data is kind of taking a back seat right now to present of like what's going on with lockdowns, COVID, inoculation trajectory, et cetera.
Larry, that being said, you also mentioned in your notes how JP Morgan Chase late Wednesday cut their crude oil demand estimates. The IEA also cutting crude demand forecasts. Now, I guess the question is how much attention should be directed towards inventories at this point, being a bit of a lagging indicator and sometimes difficult to kind of attribute rhyme and reason to as far as price activity. I mean, are we focused on the fundamentals, the bigger picture, the macro, or should we be looking at some of these weekly data points, some of these smaller pieces of the puzzle to kind of formulate that bigger picture? Do inventories still matter today?
Inventories do matter, but I think what matters is really just the theme of inventory. Like, the EIA report was postponed until today because of the federal holiday. And we've had 2 weeks in a row where EIA inventories were down and beat expectations on that end. But on the production side, 5-year averages were still well above. And so I think it's, one inventory report doesn't make the trend. But if you look at 2 or 3 or 4 in a row, then perhaps that's saying something. And I also do believe that, when banks come out and talk about inventory levels, demand levels, et cetera, I mean, it's all left to guess right now. I mean, there's this thing could change on a dime. And I think oil, like everything else, perhaps didn't get ahead of itself, but was looking at what the market thought was going to be true within the next 3 to 6 to 9 months, and perhaps we have to scale that back a little bit.
Okay, crude oil inventories today, the EIA will report at 11 a.m. Eastern. They're expecting to see a draw of 1.1. Last week was a draw of 3.2. We've yet to see a build this year. If we do get one, it'll be the first. Natural gas also today, that's going to be at 10:30 a.m. Eastern. That's going to be expected, I should say, a draw of 174 billion cubic feet. They had a draw of 134 last week. Larry, I want to move on but continue this, move on from the energies discussion, but continue the focus on commodities. Gold, for the most part, just hasn't really been providing a real directional conviction one way or the other. It is coming off a bit this morning. I'd imagine that's the dollar catches a little bit of a bid, but if you take a look at the range that we've been in basically since the beginning of December, we traded off the 1767 level up to 1960. For the most part, we've been finding comfort around this 1850 level, kind of right in the middle of this range we've been in over the last 6-7 weeks now.
Yeah, no, that is true. And I am no technician, but I love momentum. And with that in mind, it seems to be a sweet spot or a turning point for gold, whether it's going to have another bearish extension or if it'll bounce back. And I think all of it, or at least most of it, is really the overall reflationary ambitions of the market right now. And so that's taking a back step. So the market's on the back foot right now. But, you have to consider when you look at gold relative to the S&P 500, and it's amazing to think the S&P 500 is still trading above 3,800 with all these bearish impulses in the market, and so gold is acting more like a risk asset right now. And for it to come off like it is this morning, makes some sense when you look at the different products out there, especially the stock indexes.
Yeah, we've been watching gold and the ES. Well, we had been watching them rally off those March lower levels. The ES around 2174, rallying up into when gold was maxing out in the beginning of August, up around 2100. We saw the ES, but it's continued through and onward and upward, even as gold's lost that trajectory to the upside. Yet on the other hand, though, copper, for the most part, maybe more a reflection of what we've been seeing, Larry, in terms of the indices and the bid activity, the optimism, the expectations for infrastructure, for stimulus. I mean, gold, one could argue, lost some of its upside momentum as Europeans lost some of the initiative to continue to stimulus. Here in the U.S., we've thrown more at the problem. But the dollar, or I should say, as you mentioned, inflation not being a major concern still at this point, a bit of a headwind, it looks like, for gold. But there you can see copper has done pretty well. And, well, in many ways, I've got a chart here to show also in a minute, probably a better reflection of what we've been seeing here in terms of the ES and some of the optimism tied to what's to come, I guess one could argue.
Yeah, absolutely. And, if you look at the Dalian exchange, it saw some enormous gains in copper earlier in the week. And is some of that or most of that due to really good Chinese economic data? Perhaps.
Yeah.
I would say more than perhaps. I'd say most likely. But that said, interest rates by and large interest rates moving up by and large or theoretically aren't good for copper. But right now, it's funny, higher rates is actually good for copper because it's good for perception. It's good for what's coming forward. And so to see a backing off in rates, seeing the stock market off a little bit, copper right now is looking more like another risk asset. It seems like the whole market, there's no real correlation or separation, as it were, between assets. So copper right now is kind of moving counterproductive to the way it should, at least today. But yeah, there have been some bigger moves earlier in the week, and a lot of that is due to optimism with China.
Larry, actually, if we could just show this chart here real quick in terms of what Larry was discussing as far as that move up. We got copper is the candles here. You can see the purple line, ladies and gentlemen, is the TNX. As Larry mentioned, both have been seeing a little bit of a lift tied to some of that optimism, expectations, rates on the rise, bettering conditions. Larry, what are you dialed in on most in terms of some of these trends that we're talking about here that we've been looking at continuing? I mean, everybody's focused on the vaccine. I mentioned at the top of the show some of the concerns related to the variants that we're seeing, and will these vaccines be effective against them? What are you looking at here to continue or derail some of these trends that we've been talking about? Copper to the upside, crude oil for the most part, again, still holding upper levels around 53, struggling to get above 55, but one could argue still bid. What ultimately could provide headwinds for some of these well-defined trends, the upside in commodities?
Yeah, I think it's all focused on the pandemic right now. It's hard to argue anything other than that, and whether it be short-term news, but we just need to know the trajectory of inoculation and herd immunity and our economy getting back to some sort of normalcy, as it were. I mean, it's never going to be the way it was per se. It's going to change. And if this K-type recovery, what does it really look like? And I think that matters the most right now. I don't think anything else does. If anything mattered behind it, it would be just the amount of fiscal stimulus and easy monetary policy. But I think those things are in place for years to come.